Hi everyone. In today's class, we are going to be dissecting the underlying concept of break-even analysis or cost volume profit analysis. So what do you understand by break-even analysis? The break-even analysis represents the uses of marginal costing concepts to analyze and establish a relationship between cost, volume, and profit at different activity level in making managerial decisions. Okay, the break-even point is the point where total cost equates total revenue. Like I said, break-even point equates total revenue, the point where total revenue equal to total cost, which is equal to 0, which means that at any point above break-even point, the company will make profit. Then at any point below the break-even point, the company will make loss. Look at, if your break-even point is equal to 0, anything above 0, that will be profit. Then any point below 0, that will be loss. So when a company wants to break even, all right, it means that the company is not interested in making profits or in making losses. They just want, worst case scenario is for me to be able to break even. All right, that is the target of break even analysis. However, break even analysis is very practical, very practical in the sense that every business organization needs break-even analysis, needs the knowledge, the concept of break-even analysis. Say for example, for startup or any entrepreneur or any business organization, be it a new one or an existing business, you need the concept of break-even analysis when you are making financial planning or financial projection. For example, if a company wants to borrow money, wants to borrow loan, there is a project that the company wants to execute, but the finance is not readily available. The company may need to approach investor or a lender that, please, I need so much money. One key important document that the prospective investor or lender will ask the company is the business plan or feasibility study report. Inside the feasibility study report or the business plan, the company will need to include the break-even analysis of the business or the short-term financial summary. It could be 1 year, it could be 3 years, it could be 5 years financial summary, because the prospective investor wants to see how the company will be able to generate revenue, the sources of the revenue for the company, and then the likely expenses that the company will incur, which will include how the company will be able to pay the interest, okay, on the loan that the company wants to borrow. Not only that, you need to demonstrate for me that you are going to run this business profitably. Therefore, if the company is not able to make profit, of course, the financial summary will show the financial performance of the business, how the company will be able to make profit. Not only that, the worst case scenario will then be that, okay, even if you don't make profit, then you should be able to break even. However, how do you calculate the break even? How do you determine the break even? All of that will be included in the business plan. Whether it's a manufacturing company or a service company, you can determine the break even point, for each of the, for whatever the entity. All right, so that is basically what break-even analysis is all about. And the break-even analysis relies heavily on the behavioral classification of cost, which simply means that a cost item must be capable of being classified as either variable or fixed cost. All right, as either variable or fixed cost. So you recall that when we had the lecture on short-term decisions, I mentioned that marginal costing concept is designed principally to aid managerial decision. When a company wants to make decision in decision making, you need the concept, you need the technique of marginal costing. So as a result, I listed about 9 areas in which you can apply marginal costing technique to aid managerial decision, including CVP analysis. CVP is one of the areas in which you can use marginal costing concept to aid managerial decision. So decision now is that, in practice, decision now is that, okay, how many units do we need to produce in this year for us to be able to break even? That's a decision. You want to know how many units the company will produce, okay, in order to break even. It is also possible that the company, that is in units, the company may also want to know how much sales value are we going to earn in the market for us to be able to break even. It is also possible that the company may be financially aggressive than such that the company wants to earn profits, where we don't want worst case, we want to earn profit. Therefore, depending on how the company is, how ambitious is the company. Say, for example, a company wants to earn 1 billion profit. Okay, so how many units, how many sales value, or how many units are we going to produce for us to be able to earn a targeted profit of 1 billion? Or how many sales value do we need to make, do we need to generate in the market for us to be able to make a targeted profit of 1 billion? Which means that because you already have a targeted profit that you want to earn, what that means is that the company will be motivated. The target is on the goal, the targeted profit of 1 billion. So that will now encourage the company to carry out aggressive marketing for the company to be able to earn that profit, that targeted profit. So you use break-even analysis to achieve all of this. All right. However, there are some underlying assumptions that you need to take into consideration as far as break-even analysis is concerned. The first assumption is that variable costs remain constant. Fixed costs will not change. Selling price will not change. The method of production, technology, production efficiency, labor efficiency, all of that will remain constant, will not change. There will be no inflation. All right. There will be no price level changes. So these are some of the assumptions of break-even analysis. Okay. Like I mentioned, what is important is that the fixed cost, variable cost, selling price will remain constant, will not change, because once each of any of those ones change, then you need to calculate another break-even. So our bottom line is that all those variables will remain constant, will not change. Okay. So those are some of the objectives, some of the underlying assumptions of break-even analysis. So you can just go through this, you have better understanding on that. However, what do you understand by contribution margin? So we are coming back to the objective of CVP. So what do you understand by contribution margin? Contribution margin simply means the difference between selling price and variable cost per unit, or total sales, the difference between total sales and total variable cost. It can also be said to be the summation of fixed cost and profit. Okay, that is contribution margin, depending on the information available. Therefore, how do you calculate contribution margin per unit? So you can say contribution margin per unit is computed as total sales minus total sales minus total variable cost, then divide by total sales. That will give us divide by number of units. That will give us contribution margin per unit. Okay, so of course this is total contribution. All right, for you to get the total contribution margin, it is simply total sales minus total variable cost. So in this case, when I now want to determine contribution per unit, I can say total sales minus total variable cost, that is total sales minus total variable cost divided by number of units, divided by units. So this will give me contribution margin per unit. Okay, if I want to get total contribution, it is total sales minus total variable cost. Okay, that's for that. Then the second one It depends on the information. If I'm given selling price in the question, so I will just say selling price contribution per unit is equal to selling price minus variable cost per unit. So I will get the same thing. Then if I'm given contribution, if I'm given fixed cost and profit in the question, there is no sales value, then contribution per unit or total contribution is fixed cost divided by profit. Okay, if I want to do contribution per unit, that would be fixed cost per unit plus profit per unit. So that will give me contribution. All right, so this is how to calculate contribution per unit. Then what do you understand by contribution margin ratio? The contribution margin ratio simply means the ratio of contribution to sales. All right, the ratio of contribution to sales. It is also known as profit volume ratio. It is also known as profit volume ratio. It can be calculated in several ways depending on the information available. So when you are calculating contribution margin ratio, if you want to use total, you can say total contribution divided by total sales. So that will give you contribution margin ratio. If in the question you can see selling price and variable cost per unit, then contribution margin ratio is simply selling price minus variable cost divided by selling price. Of course, everything must be in percentage. Then it is also possible in the question you are given total value. You don't have contribution, but you are given total sales and you also have total variable cost. Therefore, contribution per unit, contribution margin ratio is the total sales minus total variable cost divided by total sales. Of course, in percentage, okay? Multiply everything by 100%. If in the question, there is no selling price, there is no sales, and there is no variable cost, but what you have is just profit and as well as the fixed cost. Therefore, contribution margin ratio is fixed cost plus profit divided by sales value. Of course, sales will be available, but you don't have variable cost, you don't have contribution. What you have is the fixed cost and the profit. You also have sales value. Then this is the formula to use to calculate the contribution margin ratio. Now, before we talk about the objectives of break-even analysis, there are 4 key objectives for break-even analysis, but before that, let's talk about margin of safety. Let's talk about margin of safety. So the margin of safety is the level of output, is the level of output at which the organization will start incurring, the level of output that can fall before an organization will begin to incur losses. What is the degree of decline? What is the degree of fall in output before a company will begin to incur losses? That is what margin of safety wants to achieve. Just like you have in the under risk and uncertainty, under sensitivity analysis. All right. So it's margin of safety measure the same thing. As far as break-even is concerned, you want to know what is the extent to which your output can fall before a company will begin to incur losses. All right, and it is calculated as the difference between the budgeted sales and the break-even points of sales, or budgeted sales units minus the break-even points in unit. All right, so you can also calculate break-even points in percentage depending on the requirement or on the information available. Okay, so margin of safety is budgeted sale minus break-even point of sales. This may be in naira, it can also be in units. If it is in units, then budgeted sales units minus break-even point in units. Okay, budgeted sales units minus break-even point in unit. Then, of course, it can also be computed in percentage, which is budgeted sales minus break-even point of sales. All right, divided by the budgeted sales. So that will give you the percentage of the margin of safety. Say, for example, remember we said that the break-even point is the point where there is no profit and then no loss. All right. So your margin of safety is that you don't want to any point above your break-even points. Okay, so the margin of safety is just the difference between the point above the break-even and the break-even itself. All right, so say for example, let's say we have a diagram like this. Okay, let's say here is our break-even point. Here is our break-even point. Okay, here is a point where a company has a targeted profit or something. There's a profit here to earn a targeted profit. So here is where you have the break even. So here is your margin of safety. So any point below, any points between this is where you have the margin of safety. That is where you have the margin of safety. And that's why we are saying that the margin of safety is the extent to which the output of the company can fall before incurring losses. All right. So any point below the break-even point, you know you are going to have a loss. But your margin of safety is between this point and this point. That's the interpretation. Okay, so that's that. Then let's talk about objectives. The underlying of the objectives of break-even analysis. There are 4 key objectives of break-even analysis. I've talked about it earlier today. There are 4 key objectives. One is that what is the number of units a company must produce, okay, in order to break even. That's one objective. The second objective is to determine the sales value required to break even. Okay. The third objective is to determine the units required to earn a targeted profit. And the fourth one is to determine the sales value required to achieve a targeted profit before tax. So those are the 4 objectives. Those are the 4 objectives of break-even analysis. Okay, so you can just go through all of this. That is in simple form. That's what I just said. So how do you then determine break-even? How do you determine break-even? So how do you determine break-even? How do you calculate break-even point? So let's demonstrate. Let's have all the relevant formulas that we can use to compute break-even analysis. Okay. There are 6 different formulas that you can use depending on the information available. However, when you want to calculate break-even points, your focus is on the objectives that the company wants to achieve. The first objective is to determine the number of units required in order to break even. So for you to be able to do that, then the break-even point in units will be computed as total fixed cost divided by contribution margin per unit. Okay, total fixed cost divided by contribution margin per unit. So that will give you a break-even point in units. The second objective is to determine the sales value required to break even. So when you want to determine the sales value required to break even, okay, so you calculate break-even points in value. So the break-even point in value is fixed cost divided by contribution margin ratio. And you know, we've discussed how to calculate contribution margin ratio. Then the third objective is to determine the units required to achieve a targeted profit before tax. Okay, to achieve a targeted profit before tax. Therefore, how do you then calculate break-even in units for this purpose? So to determine break-even points in units to earn a targeted profit before tax, it is simply the fixed cost plus targeted profit divided by contribution per unit. Okay, total fixed cost plus targeted profit divided by contribution per unit. Your total fixed cost, all you need to do is to sum up all the fixed costs. Okay, you can have fixed marketing expenses, fixed admin expenses, insurance, depreciation, all the fixed costs that you have. Add all of them together. That will give you the total fixed cost. Once you have that, you add it to the targeted profit before tax. Okay, ordinarily it should be total fixed cost plus targeted profit before tax. All right, then divide by contribution margin per unit. So this will give you break-even point in unit. All right, because the profit to be used, your targeted profit should be profit before tax. So if profit after tax is given to you, you are expected to convert it to profit before tax. However, we'll come back to that one later on. However, if you now want to compute uh, sales value required to achieve a targeted profit before tax. In this case, it will be total fixed cost plus targeted profit divided by contribution margin ratio. You notice that anytime you want to compute break-even point in units, the denominator is contribution per unit. Anytime you want to compute break-even point in naira, the denominator is contribution margin ratio. Watch out for that. So, like I said, the targeted profit to be used should be profit before tax. Therefore, if profit after tax is given, it should be converted to profit before tax before computing break-even point. So for this purpose, if you are asked to calculate number of units required to earn a targeted profit after tax, okay, to earn the targeted profit after tax, you are expected to convert the profit after tax to profit before tax. How do you do that? So your total fixed cost plus targeted profit before tax, okay, total fixed cost plus targeted profit after tax as given to you, then divide by 1 minus tax rate, then all divide by contribution margin per unit. So this will give us the break-even points in units to earn a targeted profit after tax, because you don't use profit after tax. It has to be profit before tax, and that's why we are converting the profit after tax to profit before tax. So when you divide the profit after tax by 1 minus tax rate, that will take it back to profit before tax. Then lastly, if you're asked to compute sales value required to earn a targeted or intended profit before or profit after tax, okay, if profit after tax is given to you, then break-even point in naira to earn a targeted profit after tax will be computed as total fixed cost plus targeted profit after tax, then divide by 1 minus tax rate, or divide by contribution margin per unit. Okay, contribution margin per unit. So these are the formulas you are expected to, these are the 6 formulas you are expected to carry out whenever you want to determine break-even points for an organization. Okay, and I believe this is clear. Now, all these formulas I've demonstrated so far, they are meant for a single product organization. So we are going to talk about, the next thing we are going to do is to talk about break-even for a multi-product organization. But before we go to that, let's talk about, let's have illustration to demonstrate. Okay, let's have illustration to demonstrate our learning under for a single product organization. All these 6 objectives, let's see, we can have a question that will be able to help us to demonstrate that. All right, so let's go for illustration. So let's have this illustration number 1. It's a complete illustration under for a single product organization. When you say single product organization, a single product organization is a company that produces only one product, singular product. All right, so that's that. Then in this illustration, Marina Industry sold 150,000 units of its product at 20 naira per unit. Variable costs are 15 naira per unit, including manufacturing cost of 12 naira and selling expenses of 3 naira, making 15 naira. Fixed costs are incurred uniformly throughout the year and amount to 972,000 naira. That is manufacturing cost of 600,000 and selling expenses of 372,000. Okay, you are required to calculate A, the break-even point in unit and naira. B, the number of units that must be sold to earn an income of 75,000 naira before income tax. C, the number of units that must be sold to earn an after-tax profit of 100,000 naira if the income tax rate is 40%. D, the number of units required to break even if variable cost increased by 5% and fixed cost increased by 2.5%. This is a complete question under break even. So let's review it. All right, so what are you supposed to do? In the first requirement, you are to calculate break-even point in units and in naira. The first thing that should come to my mind is that, okay, I want to calculate break-even point in units. I know that break-even point in unit is computed as total fixed cost divided by contribution margin per unit. Therefore, I will go to the question, what is the fixed cost? We are told that fixed cost is 972,000. Therefore, what is the contribution margin per unit? I will go to the question, what information do I have to compute my contribution per unit? Am I given variable cost per unit? Am I given selling price per unit? Yes, in this question, the selling price is 20 naira per unit. The variable cost per unit is 15 naira. Therefore, 20 naira minus 15 naira, that would give me 5 naira per unit. So to now get the break-even point in units, I will then say 972,000 divided by 5 naira, I will get my answer. So now this is what I'm trying to say. The fixed cost in this question is 972. All right. The contribution margin per unit is 5 naira. Therefore, break-even point in unit is 194,400. 194,400. All right. The second part of the requirement says that we should calculate break-even point in naira. Therefore, to get my break-even point in naira is the total fixed cost divided by contribution margin ratio. So I need to go and calculate contribution margin ratio. Contribution per unit is 5 naira. Selling price is 20 naira. Therefore, 5 naira divided by 20 naira will give me 0.25. All right, so that's 0.25 is the contribution margin ratio. So for me to now get the break-even point in naira or in value, it will be fixed cost of 972,000 divided by 0.25. That is what produce 3,888,000. That's the break-even point in naira. So what is the implication of this? What this simply means is that for the A part, the company must produce 194,400 units in order to break even. Any units below this 194,400, the company will make loss. Any units above 194,400, the company will make profit. The same thing for the sales value. This is the amount, 3,888,000 is what the company should sell. That is the sales value the company must earn in the market in order to break even. Any point, if the company makes sales beyond 3,888,000, the company will make profit. If the company earn profit, if the company makes sales below 3,888,000, the company will make loss. All right, the company will make loss. So this is the interpretation of the break-even point that we have computed. All right. Alternatively, if I don't want to follow, since I've already computed break-even point in unit to be 194,400, and I'm asked to calculate break-even point in naira, all I need to do is to just multiply the break-even points in units, 194,400. I will multiply with the selling price. That will give me break-even points in naira. So that is what I've demonstrated there. This is an alternative way of calculating your break-even points in naira. If, for example, in the question examiner asks you first that you should calculate break-even point in naira, and you have gotten 3,888,000, you are now asked to calculate break-even point in units. You can also divide your break-even point in naira, you divide it by the selling price. In this case, I will just say 3,888,000 divided by 20 naira. That will give me 194,400, which is consistent with the initial break-even point in naira. So depending on the information given in the question. So number B of the question is that you are required to calculate the number of units that must be sold to earn an income of 75,000 naira before income tax. So you want to earn an income of 75,000 before tax. Therefore, how do you, the examiner is asking you to calculate number of units. So in this case, the number of units will then be fixed cost plus targeted profit divided by contribution. Fixed cost is 972,000. All right. Targeted profit that the company wants to earn is 75,000. Therefore, 972,000 plus 75,000 divided by 5 naira. 5 naira is the contribution margin per unit. Okay. Therefore, 1047,000 divided by 4 will give us 209,400,000. So for the company to be able to earn this targeted profit of 75,000 naira, the company must be able to produce 209,400 units. If the company fails to meet up with these targeted units, if the company, say for example, the company produce 200,000 units, the company will not be able to earn the targeted profit of 75. But if the company produce, say for example, 210,000 units, it means that the company will earn more profits beyond the 75,000 targeted. All right, so that is the implication. All right, so let's go to number C of the requirement. In the C requirements, you are to calculate the number of units that must be sold to earn an after-tax profit of 100,000 naira if income tax rate is 40%. Remember what I said, you don't use profit after tax to compute break-even point. Rather, you should use profit before tax. Therefore, if profit after tax is given, it should be converted to profit before tax before computing the break-even point. So for this purpose, the best formula to use is to pick the total fixed cost. Okay, total fixed cost, let me rewrite that. So this will then be the total fixed cost plus targeted profit after tax given to me, then of course divide by 1 minus tax rate or divide by contribution margin per unit. Okay, so the targeted profit after tax is 100,000 naira. Tax rate is 40%. 1 minus 40% will give us the 60%. Okay, so of course, this is the 972 for the total fixed cost. 100 divided by 0.6 will give us 166,667. All right, so just use calculator to do the final answer. There's no all those step it's a waste of time. Simply say 972,000. Before you get to 972,000, 100,000 is the profit after tax, then divide by 0.6. 1 minus 0.4 is 0.6 equal. All right, then plus 972,000 fixed cost equal, then divide by contribution margin per unit of 5. That's equal to 227,733. That is how we arrive at the number. That is how we arrive at this number. Okay, that is how to calculate the break-even point in unit to earn a targeted profit of 100,000 naira. Okay, number D requirement of the question. You have to calculate the number of units required to break even if variable costs increase by 5% and fixed costs increase by 2.5%. Break-even point in units to break even if variable costs increase by 5% and fixed costs increase by 2.5%. Remember, one of the assumptions of break-even analysis is that fixed costs and variable costs will remain constant, will not change. Fixed costs will not change, variable costs will not change, selling price will not change, there will be no price level change, there will be no inflation. The method of technology, all right, production efficiency, all of that will not change as well. The method of technology, method of production will not change. All right. So if this is the case, examiner is now asking us, now telling us that, okay, what if variable cost, even in reality, you know that those assumption is not tenable in reality. In practice, it's not possible that the fixed cost will remain the same. It's not possible. You can't say in an economy there will be no inflation. All right, so these are just theoretical assumptions. It doesn't hold water in practice because it's not possible that selling price will remain constant. Selling price will not change. But for the purpose of achieving our objective, that is why all those assumptions are being designed. However, in this number D requirement, we have been told that variable cost will increase by 5%, fixed cost will also increase by 2.5%. Before you compute your break-even point in units, the most important thing that you need to do is to first of all go and adjust your variable cost. Once your variable cost changes, either increase or decrease, then that means your contribution margin per unit will also change, because we are told that selling price is constant, all right, but variable cost will change. Once variable cost changes, then of course contribution margin will also change. Again, our fixed cost has increased by 2.5%, so we need to go and make adjustment first. So for us to be able to compute the D part, let's go and do our adjustment. So the first calculation, the first working we are going to do is to adjust the variable cost. Original variable cost is 15 naira. We are now told that variable cost will increase by 5%. So 5% is the same thing as 5 divided by 100. 5 divided by 100 will give us 0.05. Therefore, if you now want to determine the increase in variable cost, I would then say 15 naira is the original variable cost. All right, 15 naira is original variable cost. So multiply by 0.05. Okay, I would then say there's no need for you to be doing all of this. I'm just trying to multiply by 0.05. That's 0.75. That means the increase in variable cost is 0.75. Original variable cost is 15 naira plus 0.75. This will give us 15.75 naira. So there's no need to be doing all of this. It's a stress. You already know that the variable cost will increase by 5%. The 15% is 100%, which is 1. The 0.5% is the increase of 5%. Therefore, 15 multiplied by 1.05 will give me 15.75. That's what you should do. You can't be doing all this primary school. It's a waste of time. Then we also told, of course, once the variable cost changes, like in this case now, variable cost has increased to 15.75. It means that we need to recompute our contribution margin. The selling price is 20 naira. It's not changing. The new variable cost is 15 naira 75 kobo. Therefore, the new contribution margin ratio is now 4 naira 25 kobo. The last change that we need to compute is the fixed cost. We are told that fixed cost will increase by 2.5%. Again, 2.5%, the 972,000 is 100% plus the 2.5%. Okay, this will give me 102.5%. The 102.5% is the same thing as 1.025. So all I need to do is to now multiply the 972,000, okay, plus 1.025. That is what produce, okay, 996,300. That's what you have here. Again, there is no need for you to be doing all of this. It's a waste of time. Just multiply 1.025 by the 972, you get your answer directly. So now that we have made adjustment for variable costs, we've determined the new contribution margin ratio and the fixed cost. We then go ahead and compute the break-even in units. So the new fixed cost is 996,300. The new contribution margin per unit is 4 naira 25 kobo. All right. So when you put this in your calculator, you get 234,424 in units. So that's that. So if all these changes are made, then the number of units the company must produce in order to break even will then be 234,424 units. So that is the end of the question. Basically, this is how to calculate break-even points in units and also in naira. So that's that. So at this point, we need to move to multi-product break-even. There are other examples in the question that you can try on your own. All right. There are other examples that you can try on your own. Let me see. Let's have one more illustration. Let's have one more illustration under single product. So we do 2 illustration for single product and 2 illustration for multi-product. So yes, the following information is extracted by a financial analyst from the book of Ojopagogo Industry Limited. Okay, we are given sales value, variable cost, then fixed cost. A, you are required to calculate the profit volume ratio to the break-even point. B, a proposal has been made to increase fixed cost by 100,000 naira if sales and variable costs remain unchanged. Compute the new break-even point. B2, the company is also considering another proposal for modernizing its existing plants. This will need additional fixed cost of 25,000 naira with the expectation of saving the same amount in each of the direct materials and the direct labor costs. If this proposal is undertaken, compute the profit of the company, the profit volume ratio, and the break-even points. Number C, management accounting has an important role to play in decision making. Discuss this statement, explaining the concept which may be relevant and enumerate types of decision to which they may be applied. So without wasting time, examiner is asking in this question that you should calculate profit volume ratio. Remember, contribution margin ratio is the same as profit volume ratio. So to get the profit volume ratio, you are expected to divide contribution per unit with the selling price per unit, or simply say divide contribution by sales. So that will give you profit volume ratio. So without wasting time, I will go to the question. What information do I have to calculate my PVR, profit volume ratio? In this question, there is no number of units. I'm not given selling price. All I have is total sales. I also have total variable cost of 800,000. Therefore, the difference between total sales and total variable cost will give us contribution of 200,000. So this 200,000 represents contribution. This is the contribution. Okay, now that I have the contribution, I want to calculate PVR. My PVR will be the contribution of 200 divided by 1 million. So let's go and calculate that quickly. So this is the 200,000 divided by 1 million naira. That will give us 20%. So PVR is 20%. The second requirement in the A2, you have to calculate break-even points. So what kind of break-even point? Is it break-even in naira or break-even in unit? In this case, it has to be break-even point in value, because in the question I don't have selling price, I don't have number of units. So the best break-even point I can calculate that I have the information is break-even point in value. So for us to be able to do this, break-even point in value is the total fixed cost divided by profit volume ratio. Total fixed cost in the question is the total fixed cost is 100,000. Okay, so 100,000 divided by 0.2 will give us a 500,000 naira. This is the 100,000 divided by 20%. That is 500,000. So break-even point in naira is 500,000. Then I will then go to number B. Number B1, you are told that a proposal has been made to increase fixed cost by 10,000 naira. If sales and variable costs remain unchanged, compute the new break-even point. Our current total fixed cost is 100,000 naira. So if fixed cost increase by 10,000, that will be 110,000. That is 100,000 plus 10,000. That is 110,000. 110,000 divided by PVR of 0.2. That will give us 550,000. Okay. So 100,000 plus 10,000 divided by 0.2. 110 divided by 0.2, that's 550,000. That solves the question. The next one, number B2, the company is also considering another proposal for modernizing its existing plants. This will need additional fixed cost of 25,000 naira with the expectation of saving the same amount in each of the direct material and direct labor costs. If this proposal is undertaken, compute the profit of the company, the profit volume ratio, and the break-even point. This is very straightforward. What the examiner is simply saying here is that, okay, there's a proposal for modernizing existing plants of the company. So this proposal will require additional fixed cost of 25,000 naira. If we incur the fixed cost of 25,000 naira, then we can save the same amount on direct material and direct labor, which means that direct material will reduce by 25,000. Direct labor will also reduce by 25,000. So all I need to do is to recompute my income statement. Originally, direct material is 300,000 naira. So 300,000 minus 25,000 will give me 275. Again, direct labor is 300,000 minus 25,000 will give me 275. And then my total fixed cost originally is 100,000. This new proposal will mean that there's going to be additional fixed cost of 25,000. So my fixed cost will now increase to 125,000. So let us go and recompute the revised income statement. Okay. So this is the revised income statement. So sales value remains the same. However, my direct material has reduced because we are saving 25,000. It has reduced to 275. The same thing applied to direct labor of 300,000. We are saving 25,000. So that has reduced to 275,000. Every other figures under variable cost remain the same. Therefore, the total variable cost now is 275,000. 275 minus 1 million, sorry, 750,000 minus 1 million will give us a new contribution margin of 250,000 naira. Then for the fixed cost, the factory fixed cost remains the same as originally inputted. Marketing expenses is the same thing as 30,000. Administrative expenses is the same thing as 20,000. However, there's an additional fixed cost to be incurred, which is 25,000. When you add it up, that is 125,000. So to now get the revised profit, then 250,000, the new contribution margin, divided by the minus the new fixed cost of 125. So that means revised profit is 125,000. Now, that is what examiner wants us to do. Then you also asked in that particular requirement, you also asked to calculate the new profit volume ratio and then the break-even point. So for me to now get the new profit volume ratio, I'm supposed to divide the new contribution margin of 250,000 naira by the sales value of 1 million naira. That will give me 0.25. So this is the new PV. That's the new PV. Then with this, since I have a new PV, my fixed cost has also changed. Then the break-even point in naira is now 500,000 naira. Okay, I believe this is clear. So that's that. Very straightforward. Then number C of the question, you are asked to explain the concepts. You are to discuss we are told that management accounting has an important role to play in decision making. Discuss this statement explaining the concept which may be relevant and enumerate types of the decisions to which they may be applied. Remember, when we had short-term decisions, and I mentioned that anything that has to do with decision making, you need the concept of marginal costing technique. All right, you need the concept of marginal costing technique. So what the examiner is simply saying here is that you should explain the concept of marginal costing technique and relevant costing principle. That is basically what you are supposed to do here. Now, so this is the response. This is the solution to that number C. All right. Management accounting plays an important role in decision making to provide management with relevant and useful information suitable for making specific managerial decisions. The concepts which may be relevant to the role of management accounting include marginal costing technique, relevant costing concept or principle. All right. Then what you need to do now is to explain what is marginal costing concept, what is relevant costing concept. All right. Then the marginal costing concept is a decision-making technique designed principally to analyze and compare the total relevant cost and the associated benefit of a particular course of action in making managerial decision. All right. It is also known as the cost benefit analysis, in that a cost item must be capable of being classified as either variable or fixed cost. Okay, with the help of marginal costing technique, management can concentrate on the courses of action that are critical and strategic to the business success to achieve a targeted organizational objective. All right. So for this purpose, marginal costing technique is designed principally to aid managerial decision in the following areas. Okay, look at what I mentioned earlier today that I listed. So these are the areas in which you can apply marginal costing concepts to aid managerial decision. Under cost volume profit analysis, you can use marginal costing, and that's why we are separating fixed cost from the variable cost. Under deleting of a segment, when a company wants to discontinue a particular unprofitable segment, then you need the knowledge of or the concept of marginal costing. Then when a company wants to make a decision as to whether to make or buy a particular component or a product, then you can also use the concept of marginal costing. It is also possible when there's a special order, the company may want to know whether the order should be accepted or rejected. All right, so to do this, you need the concept of marginal costing. Then not only that, in shutdown of capacity, if a particular capacity, a particular capacity is not suitable or is becoming problematic for the organization, the company may want to shut it down, especially if it is not profitable. So for this purpose, then you need the concept of marginal costing to do that. Under optimal product mix, you also need the knowledge of marginal costing concepts to analyze that. Where there's linear programming, okay, you also need the knowledge of marginal costing concept. For the optimal product mix and the linear programming, of course, as you know, when a company does not have sufficient resources, factor of production to produce, so the little that the company has will need to be allocated among competing product line in order to help the company to achieve its single objective of maximizing contribution or minimizing cost. But the bottom line is that you are going to need the knowledge of marginal costing for the company to be able to determine optimal production plan that will maximize contribution for the organization. Again, when a company wants to add a new product, then you need the knowledge of marginal costing. Not only that, in pricing decision, okay, you also need the concept of marginal costing. Let me add pricing decision, okay, pricing decision. So you need the knowledge of marginal costing. 1, 2, 3, 4, 5, 6, 7, 8, 9. So these are some of the areas in which you can apply marginal costing technique, okay, to aid managerial decision. So this is on one side of the requirement. The second part is relevant costing concept. What do you understand by relevant costing? Relevant costing is a principle of the relevant costing concept is a principle of relevant costing which can be used, okay, to assist management in making informed and appropriate managerial decision relating to a particular course of action. So for this purpose, relevant costs are costs that are directly attributable to a course of action in making managerial decision. So the management accountant will need to apply the relevant costing principle to the course of action that will have economic and financial consequence on the decision that is to be made. Therefore, relevant costs, there are basically three attributes of relevant costing. Okay, there are three attributes of for a cost to be relevant. These three attributes or quality or determinant or factors must be taken into consideration. One is future, the other one is cash flow, then relevant cost must be incremental in nature. So when you talk about future costs, so relevant costs are future cash flows, all right? They must be a cash item that has not been incurred at all. So any costs that have been incurred in the past, those are sunk costs, which of course is irrelevant. Then again, we talk about cash flow. Relevant costs are future cash, they must be cash item. So any notional cost like depreciation, amortization, provision, interest, those are not cash flow. You don't consider them because relevant costs must be cash flow. Then the last one is incremental. Incremental costs are costs that change between alternative as a result of the decision that is to be taken. Any increase or decrease in cost item in making a particular course of action or in taking a particular course of action is what is known as incremental cost or incremental cash flow. So these are what examiner wants you to explain in that number C requirement, and that's end of the question. Now the next thing we want to do is to talk about multi-product break-even. Okay, so the way you compute break-even point for a single product organization is different from the way you are expected to compute break-even point for a multi-product organization. So a multi-product organization is a company that produces more than one product. Okay, when a company produces more than one product, then because the way you are going to compute the break-even points must be different. Okay, it must be different from the break-even point of a single product company. This is because a multi-product organization that has different products we also have different selling price and different variable costs. So which means that each of the product cannot have the same selling price or variable cost. So for this purpose, when computing the break-even point for a multi-product organization, there are 5 key procedures you have to take into consideration. The first step you are going to do is to determine the overall break-even, to calculate the overall contribution margin ratio. Okay, the contribution margin ratio for the organization as a whole. So you are less concerned with any of the products. The focus is the organization as a whole. So you are computing contribution margin ratio for the entire organization, meaning that the total contribution margin for the organization divided by the total sales for the organization. So that will give you the contribution margin ratio. That's step 1. Step 2 is to compute the break-even point in value. Compute the break-even in value for the organization as a whole. In this case, this break-even point in value is not related to any of the product. It's for the organization. How do you do it? So to get the break-even point in value for the organization is the total fixed cost divided by the contribution margin ratio you have computed in step 1. All right, so that's that. Then in step 2, you are supposed to calculate sales mix. All right, you are supposed to determine sales mix for each of the products. Okay, the sales mix is computed by dividing the sales value of each product with the company's total sales value. Say for example, you have product A, you also have product B. All right, you are given sales of product A to be 1,000. Sales of product B is 1,200. So total sales now for the organization is 2,200. So if I want to determine sales mix of A, so A will then be equal to the sales value of A, which is 1,000, divided by total sales of 2,200, equal. Then I will also calculate for B. The sales value of B is 1,200 divided by total sales of 2,200. So when you use your calculator to do this, 1,000 divided by 2,200, that's 0.45. Here is 0.45, which is the same thing as 45%. Okay, then 1,200 divided by 22 equal, that's 55%, 0.55, which is the same thing as 55%. So this is how to calculate sales mix. So sales mix is just the sales value of each product divided by the total sales of the organization. So that is that. Then step 4 is to determine break-even points in value for each product. Then step 5, break-even points in units for each product. To get the break-even points in value for each product, all you need to do is to multiply the overall contribution margin, the sales value you have computed in step 2, the overall break-even points in value you have computed in step 2, you multiply with the step 3, the sales mix of each product. So that will give you the break-even point in value for each product. And to get the break-even point in unit for each product, just multiply the break-even point in value with the divide it with the selling price. Okay, so you can match the two of them together in a table. So you use this particular table to achieve it. So the 6 means you put it here. All right, then you now say, for example, the break-even point in the overall break-even point is 5,000, for example. So for me to now get the break-even point in value for product A, I would then say the 6 means of 0.3 multiplied by 5,000. That's what produced this 1,500. I will go to product B. 6 means of product B is 0.3 multiplied by 5,000. That's how I got the 1,500. Do the same thing for product C. 0.4 multiplied by 5,000. That's 2,000. So everything must equal to 5,000. Now, for me to now get the break-even points in unit for each of the products, I need to divide the break-even point in value for each product with the selling price. Therefore, 1,500, for example, the last one is 2,000. I will say 2,000 divided by 8 selling price. That's what gives this 250. For this B part, 1,500 divided by 15, that will give us 100. That's how we got the 100. Then 1,500 divided by 10 will give us 150. So this is how to compute break-even for a multi-product organization. So let's have illustration to demonstrate our learning so far. So let's have illustration. Let me see. All right. These are single products. Yeah. That's a multi-product, but let's go for, okay. Let's have this illustration number 6. So ignore the B, ignore the A. What is break-even point? You already know that. So number B requirement, Baba Sui Nigeria PLC manufactures 4 products at its Abidjan plant. For the coming financial year, its budgeted sales and cost structure for the product are as follows. The budgeted fixed cost for the same period amount to 4 million naira. You are required to determine the number of units of each product to be produced for the company to 1. Break even, and 2. Earn a profit of 2 million. First thing that should come to your mind is that this company has 4 different products, product A, B, C, and D. So this is a multi-product organization. You are now asked to compute the break-even, okay, to compute the break-even point. So how do I compute the break-even point? Like I explained, the 5 procedure is what you are supposed to carry out. The first procedure is to determine the overall break-even point, to determine the overall contribution margin ratio for the organization. In step 2 is to compute the overall break-even point in naira for the organization. Then step 3, compute the 6 means. Then step 4, determine break-even points in value for each product. Then step 5, compute the break-even points in unit for each of the products. So quickly, let's go through it. So again, you already know the definition of break-even points. Then number B, I want to compute the overall contribution margin ratio. I will then go to the question, how do I compute my overall contribution margin ratio? Okay, how do I compute my overall contribution margin ratio? In this question, I'm given sales value. The total sales value is 18 million naira. Total variable cost. Variable cost is given as a percentage of sales. Sales value is 18 million. So 50% is variable cost. So if 50% is variable cost, then 50% will be contribution. Remember, contribution equal to sales minus variable cost. So if sales is 18 million, then I'm given variable cost to be 50% of sales. That means my contribution is equal to multiply by 50%. So my contribution is equal to 9 million naira. Okay, so that's what we're supposed to do. I will then come here. So 50% to get my contribution margin ratio. First thing first, contribution is 50% of the 18 million divided by the 18 million. That's what produced the 50%. So 50% now is the contribution margin ratio. Step 2 is to calculate the overall break-even point in naira for the organization. To do this, total fixed cost divided by contribution margin ratio. According to the question, the total fixed cost is 4 million naira. So 4 million divided by 0.2 will give us 8 million. That's how we arrive at this number. Okay. Then step 3 says we should compute sales mix of each product. What is the sales value of product A divided by total sales value? The sales value of product A is 2.250. Sales value of product B is 4050. Sales value of product C is 5400. Sales value of product B is 6300. That is what make 18,000. So therefore, let's go and include that. So 2,250,000 divided by 18 million is equal to 12.5%. That's the sales mix of product A. For product B, 4050 divided by 18,000, that's the sales mix, 22.5%. For product C, 5,400 divided by 18,000, that's 30%. Then 6,300 divided by 18,000 will give us 35%. When you add up everything, you must have 100%. That's the sales mix. So finally, all I need to do now is to compute. I will use a table to compute both the break-even points in units and in naira for each of the products. When you want to calculate the break-even points in units, in naira, you are expected to multiply the sales mix you have computed all the sales mix. You multiply with step 2, the break-even point in naira in step 2. And for you to get the break-even point in units, you are supposed to divide your step 4 with the selling price. That is the break-even point in value for each of the products divided by the selling price. So this is what we did in the table. By this, of course, we've already determined the sales mix. The sales mix is what you have here, all the sales mix. All right. So you come and put it there. Of course, everything must be equal to 1. Therefore, the first thing you are going to do is to bring, you are going to pick the contribution, the break-even point in naira of 8 million. So that's the first thing that you are going to put here. The 8 million naira is what you are going to put there. So after that, you then say 0.12 multiplied by 8 million. That's 1 million. Once I have the 1 million, I will divide it by the selling price of product A divided by 100. That is what produces the 10,000 units. Okay, I will move to the next one. I will say 0.225 multiplied by 8 million naira equal. That's how we got the 1,800,000. You have to write everything out in full. Don't restrict your number. Don't round your number. Write it out in full so that you arrive at the right answer. Then divide by the selling price of 450. That is how we arrive at the 4,000 break-even point in unit. Then I will move to the third one, which is 0.3 multiplied by 8 million equal. That's how we got the 2.4 million, then divide by 300 equal 8,000 units. Okay, equal 8,000 units. Then finally, 0.35 multiplied by 8 million equal, that's 2.8 million, then divide by 200 naira equal 14,000 units. So that's that. This is how to calculate break-even points in naira and in units for a multi-product organization. No matter how big is the question, it's the same procedure. However, in the B part of the question, examiner mentioned that you are required to calculate the break-even point to earn a profit of 2 million naira. Therefore, you want to earn a targeted profit of 2 million naira. So this will then be, you need to calculate your overall break-even point. Okay, you need to calculate your overall contribution margin ratio. Okay, your overall contribution margin ratio will still be the same thing. Okay, it will still be the same thing. It's not changing. All right, it's not changing. But what will change is your step 2, the break-even point in Naira, because to get the break-even point in Naira to earn a targeted profit before tax of 2 million Naira, the original fixed cost is 4 million plus the 2 million targeted profit. That's 6 million. 6 million divided by contribution margin ratio of 50%. That is one hand this 12 million. So it is this 12 million that you're going to share. Your profit to sales ratio still remain the same. Your profit to sales ratio remains the same. So all you need to do is to just share the 12 million the way we did. So 0.125 multiply by 12 million will give me 1.5 million. 1.5 divided by 100 we give 15,000. The second one, product B, 0.225 multiplied by 12 million, we produce 2.7 million. 2.7 million divided by 450 Naira will give us 6,000 units. 0.3 multiplied by 12 million will give 3.6 million. 3.6 million divided by 300 will give 12,000 units. Then the last one, 0.35 multiplied by 12 million will produce 4,200,000. 4,200,000 divided by 200 will produce 21,000 units. This is what examiner wants you to do. That is the end of the question. That's end of the question. So at this point, let's have one more illustration. Let's have one more illustration before we call it a day. All right. So let's solve this illustration number. Should we solve this one? Let me see. Let me see if I have more interesting. Okay. Let me see. Let's have one more. Okay, let's solve this illustration number 5. Let's solve this illustration number 5. Ekiti Industry Limited manufactures 2 products, rice flour and beans flour. The following data are projected for the coming year. A. You are required to compute the break-even sales in kilogram for rice flour, assuming that the facility are not used jointly. That means the facility are used separately for rice flour and beans flour, so they are not jointly related. Then 2, calculate break-even sales in Naira for beans flour, assuming that the facility are not used jointly. Okay. 3, composite quantity contribution margin, assuming that consumers purchase composite quantity of 60 kg of rice flour and 40 kg of beans flour. Then number 4, calculate break-even quantity of both products, assuming that consumer purchase composite 60 kg of rice flour and 40 kg of beans flour. Then number 5, composite contribution margin ratio, assuming that a composite quantity is defined as 1 kg of rice flour and 1 kg of beans flour. Then number 6, calculate break-even sales in Naira, assuming that rice flour becomes 1 kg to 1 kg complement and that there is no change in the company's cost. Okay. Then number B, define the following break-even points margin of safety. So that is the question. That is the question. So you must be able to think outside the box for you to be able to solve this kind of a question correctly. However, what are you supposed to do? In the first requirement, you are to calculate break-even sales in kilogram for rice flour, assuming that the facility are not used jointly. So I just want to calculate break-even sales in kilogram, meaning in kilogram is the same thing as in units. Okay, in units. All right, for each of the products, rice flour and the beans flour. So for this purpose, what are you supposed to do? For me to be able to calculate the break-even point in units, in this case, unit is seen as kilogram here. Therefore, it will be total fixed cost divided by contribution per unit. So I will then go to the question. For rice flour, the fixed cost for the organization is for rice flour, fixed cost of rice flour is 20,000. So what is the contribution margin of rice flour? I need to compute contribution margin. In this case, contribution margin will then be equal to variable costs, sales of 100,000 minus variable cost of 60,000, that would give me 40,000 contribution. So 40,000 contribution divided by the unit sold of 100,000 in kilogram. So that will give us 0.4. So that means contribution margin is 0.4. So this is how we got the 0.4 here. Okay, so let me just do the working first before we begin to compute. So to get the selling price per unit is 100,000 naira divided by the total kilogram of 100,000. That is 1 naira. Variable cost per unit also is 60,000 naira divided by 100,000 kilogram, that's 60 kobo. Therefore, contribution is selling price minus variable cost, that is 1 naira minus 0.6, that is 40 kobo per kilogram. Then contribution margin ratio will then be equal to contribution margin per unit divided by selling price per unit, that is 0.4 divided by 1 naira, that will give us 40%. That's the contribution margin ratio is 40%. Okay, but first thing first, in the A1 requirement, you have to calculate break-even point in kilogram for rice flour. So the fixed cost of rice flour is 20,000. Contribution per unit of rice flour is 40 kobo. Okay, so when you do that, that's what produced the 50,000 kilogram. Then A2. In the A2 requirement, you have to calculate break-even sales in naira for beans flour, assuming that the facilities are not used jointly. So I want to calculate break-even points in naira for beans flour. Remember, again, I need to go and work out what is for beans flour, the variable cost, the contribution per unit of beans flour will then be 100,000 minus variable cost of 30. That's what produces 70,000. So once I have this 70,000, I need to divide it by the activity level. Activity level is 80,000 kilogram. Okay, 80,000 kilogram. This will produce 70 divided by 80. That's 0.875. So this will then be equal to 0.875. This represents the contribution margin per unit. That's the contribution margin per unit. So once I have the contribution margin per unit, then I can then calculate the contribution margin ratio. Okay. Now, so in this case, so for me to be able to get the break-even point in sales, break-even sales in naira for beans flour, the total fixed cost of beans flour is 56,000. This is the 56,000. I will divide by the contribution margin ratio of beans flour. The contribution margin ratio of beans flour is 0.7. How do I arrive at 0.7? First thing first, what is the sales value of beans flour? Sales value of beans flour is 100,000 naira. Okay, this is the 100,000 naira. You divide it by the activity level of 80,000 kilogram. That is what produced 1.25. That is the 1.25. So the variable cost of beans flour is 30,000. Activity level is 80,000 kilogram. When you divide, you have 0.375. Therefore, contribution margin per unit of 1 naira is equal to selling price of 1 naira 25 kobo minus variable cost per unit of 0.375, and this is what produced 0.875. Again, this is a long thing. I've already done it for you here. This is what you are supposed to do. Quickly, you get your answer and then you move on from there. All right. So now that you have the contribution, then get your contribution margin ratio, which is equal to 0.7. Contribution margin ratio is 0.7. That is 0.875 divided by selling price of 1.25, and that is what produced this 80,000 naira. That is what produced the 80,000 naira. We are done with requirement number 1 and 2. Let's go to requirement number 1.3. Right? So in the requirement number 1.3, you have to calculate composite quantity contribution margin. Remember, composite quantity contribution margin, assuming that consumers purchase composite quantity of 60 kg of rice flour and 40 kg of beans flour, which means that 60% will be for rice, 40% will be for beans flour. So quickly, let's do that. Now, in this number 3 requirement, the composite contribution margin will be computed by multiplying the contribution per unit of each product with their respective weights. The weight of rice is 60%, that is 60 kilogram divided by 100 kilogram. And the weight of beans is 40%, that is 40 kilogram divided by 100 kilogram. And of course, whenever you are given the proportion of revenue or the proportion of each product under multi-product or under multi-product break-even, if you are given a proportion of the product, it means that you have to calculate contribution margin ratio. It has to be weighted average contribution margin ratio, or what is also known as composite contribution margin ratio. You only do that if you are given the proportion of each product. If you are not given the proportion, just calculate your normal contribution margin ratio. But once you are given the proportion, then in that case, you cannot just calculate only contribution margin. You have to calculate composite contribution margin ratio, or composite contribution margin per unit, or composite weighted average contribution margin per unit, or contribution margin ratio. So in this case, because examiner wants us to compute composite contribution margin, not contribution margin ratio, in the number 3, let's go back. Calculate composite contribution margin, not contribution margin ratio. So in this case, what am I supposed to do? I need to calculate contribution margin of each product. I will multiply with the weight of the first product. Like in this case, to get my composite contribution per unit, I will pick contribution margin of products of rice. Contribution per unit of rice, I will multiply with the proportion of rice. Proportion of rice is 60%, okay? Plus contribution per unit of beans. Proportion of beans is 40%. So that will give me the composite contribution per unit. So in this case, what am I trying to say? The contribution per unit of rice is 40 kobo. I've already done it here. Of rice is 40 kobo based on our calculation previously. This is the contribution per unit of rice, 40 kobo. This is what you have here, this 40 kobo here. Then contribution per unit of beans is equal to 0.875. 0.875 is the contribution per unit of beans. Therefore, to get the composite contribution margin ratio, it will then be, I will pick the contribution per unit of rice. Contribution per unit of rice is 40 kobo multiplied by the proportion of rice. Proportion of rice is 60 kilogram, which is 60%. That is what produced 0.24, plus the contribution per unit of beans flour, which is 0.875. The proportion of beans flour is 40 kilogram, which is 40%. So when you do your calculations, the first one will give us 0.24, the second one will give us 0.35. Add everything together, the composite contribution per unit is 0.59, 59 kobo. All right, so whenever you are asked to compute contribution margin or contribution margin ratio, and you are given proportion of each product, then you are going to calculate. This is the formula that you are supposed to use. Just say contribution margin per unit of product A, for example, multiply by the weighted average of product A. All right, plus contribution margin per unit of product B multiplied by weighted average of product B. That's all. It's the same thing as what you have here. It's the same thing. It's the same thing. So you get the same answer. So that is what we have done. Then number 4 of the requirements, you are to calculate break-even quantity of both products, assuming that consumer purchased composite 60 kilogram of rice flour and 40 kilogram of beans flour. Okay, in this situation, what are you supposed to do? What are you supposed to do? The break-even quantity will be computed by dividing the total fixed cost with the composite contribution per unit and share the break-even point kilogram for each of the two products using their weights. This is shown as follows. What are you supposed to do? Simple. The fixed cost of the two products, you need to compute it. For product A, fixed cost of rice, so fixed cost for rice is equal to 20,000. Fixed cost of beans equal to 56,000. When you add it up, that is 76,000. That is how we arrive at the 76,000 you have there. All right. Then the composite contribution, examiner has already told you that you should, let me go back to the question, that you should compute composite contribution. Is it number 4 or number 4? You have to compute the break-even quantity of both products. Okay, assuming that consumer purchased composite 60 kg of rice flour and 40 kg of beans flour. What this simply means is that you are going to calculate the break-even points in units for each product, taking into consideration that the proportion, the proportion of rice to be 60 kg and the proportion of beans to be 40 kg, which is, of course, you are supposed to use the composite contribution margin of 59 kobo to determine your break-even points in kilogram. Okay, so to do this, we've already determined the total fixed cost to be 76,000. The composite contribution per unit is 59 kobo. When you do that, the final answer is 128,814 kilogram. So that is for that. All you need to do now is to share this one, to share the total kilogram of 128,814 between rice flours and beans flour. Rice flours take 60% of 128,814. That is what produce 77,288. Again, beans flour we take 40% of the total of 128,814. That is what produce 51,526. Then number 5 of the requirement says that we should determine composite contribution margin ratio, assuming that a composite quantity defined as 1 kilogram of rice and 1 kilogram of beans flour. So you want to determine composite contribution margin ratio. You have to determine composite contribution margin ratio. So how are you supposed to do this? So to calculate the composite contribution margin ratio, the most important thing to do is to calculate the overall contribution margin ratio. Since composite quantity is defined as 1 kilogram of rice flour and 1 kilogram of beans flour. So this is very straightforward. All I need to do is that for me to get my overall contribution margin ratio, I need to go and recompute my contribution margin ratio. For me to do this, the selling price per unit of rice flour is 1 naira. Selling price of beans flour is 1 naira 25 kobo. When you add the two, that is what produces 2.25. The variable cost of rice, we have done it before. This is 0.6. The variable cost of beans flour is 0.375. When you add the two together, that's 0.975. Therefore, what do I need? What I need is to determine my overall contribution margin. My overall contribution margin is 1.275 divided by 2.25 for me to be able to get the contribution margin ratio. Okay, and the contribution margin ratio is 0.57. Okay, that's 0.57. Then finally, number 6 of the requirement. You have to determine break-even points in sales. Break-even sales in naira, assuming that rice flour become 1 kilogram to 1 kilogram complement and that there is no change in the company's cost. What this simply means is that you are supposed to calculate break-even points in naira for each product. Break-even point in naira for each product using the composite, using the break-even, the contribution margin ratio that you have computed in step 5. So let's go and do that. Then number 6, the total fixed cost is 76 divided by the contribution margin ratio of 0.57, and that's what produces 133,333 naira. So all you need to do is to just share this between the two products. So and you are good to go. So that's end of the question. That's end of the question. So it's as straight. Just take your time, review the notes. All right, review the notes, and you gain more insights. So the number B of the requirements, you have to determine, you have to define break-even points as well as a margin of safety. We've already done this previously. We've done it previously. The break-even point is the point where total revenue equates total cost. That is a point where there is no gain or loss. Whereas the margin of safety represents by how much output can fall before an organization starts incurring loss. It's the degree of fall or decline in output before a company begins to incur losses. So it represents the difference. Margin of safety represents the difference between total actual level of sales and break-even point of sales. It may be expressed in terms of units, sales value, or as a percentage of the original budget. So this is how to calculate break-even points for an organization. So far, we have determined break-even points for a single product organization where we saw two illustrations, and we also did break-even point for a multi-product organization. We also examined two illustrations, and that is the end of break-even analysis. Thank you.